All right. Good morning, everybody. Thank you for joining us this morning. We are going to get started. My name is Amy Nisley with Kessler Financial Group, and I'm the Life Insurance Director here. I'm here with Jeff Reed.
Good morning, Amy.
Okay. So again, we have Jeff Reed here, and he's one of our advanced consultants. So we're really happy to have him with us. Again, thank you for joining us. A few housekeeping items. All the lines are muted except myself and now Jeff. And so we'll be taking questions at the end. If you guys want, please use that chat feature, write them down. If we don't, we're going to stop at noon right on the dot though. If we don't have a lot of time, just be aware that we can have conversation after this and we can circle back with any questions that you guys have. There's a lot of new faces and not faces, but names that I see on this list. So for those that do not know me, I started in annuities back in the 2000s, went to the long-term care and the life teams. I worked at a couple large carriers, another IMO for 4 years, and then my last stint was at Minnesota Life in the life product manufacturer. I simply tell you that and the relevancy of it was because, I saw products from an idea through the design and implementation phase and how they actually reached the sales force to like you guys all on the call. So speaking of the sales force and in the field, Jeff, I want to give a few minutes of your background, and then we can hop right into it. So Jeff Reed.
Sure, thanks, Amy. I'll spend 20 minutes on my background and 3 minutes on the sales idea today, which I think is why everybody's here, right? Really quick. Been in the life insurance industry since 1997. Entered as a career agent with the Mass Mutual, and then moved my way into brokerage and ultimately into more of a marketing consultant type of role, which is where I live today, almost 20 years down the line, which is a little longer than I really care to admit some days. Today, we're going to talk about no-lapse guarantee contracts specifically, and if there's one takeaway that I want everybody to have at the end of this, it's that these are not the inflexible term to age 120 type of contracts that they used to be. They have changed dramatically, both in the underlying cost structure as well as the feature set that has now been bolted onto the base contract to make these things actually a planning tool instead of just a risk management tool. So with that as perhaps way of introduction, we need to meet the client that we're going to be talking about today, because last I checked, if these ideas we're going to talk about, these strategies aren't relevant to a specific client, then they're probably never going to see the light of day and not lead to that sale that we're all looking for. So this client, and if you're following along on the screen, you should see some bullet points popping up, is a male, age 45. He's a preferred non-smoker, and he needs a bunch of insurance. $5 million, he prefers permanent because he doesn't want to rent his coverage, and it's primarily at this point for income replacement. He makes a good chunk of change and is the sole earner, so to speak, for the family. But at the same time, it's not just about the income replacement, because he wants to integrate his risk management strategy with his retirement planning, and he does want to leave a legacy for the kids and the grandkids when he ultimately does pass away. So those are the three goals for this individual: income replacement, integrate with retirement planning, and integrate with the legacy planning. And in order to use a no-lapse guarantee contract and really take advantage of all the features that have now been added onto these products, you really need to keep in mind one thing, and that is this return of premium rider that has now crept into the majority of these contracts. It's typically available at specific points in time in that policy's lifespan. Usually the first trigger is somewhere around year 15, and that'll be for half of the premiums paid to date at that point, and then a second trigger at year 20 that will represent 100% that being available in terms of the return of premium. There is a contract out there that I would call the best in class. That's the one we're going to talk about today, that has a total of 7 windows: 50% at year 15, 100% at years 20 through 25. So you actually have a total of 7 different windows that you can execute on. And I say windows because you've got a choice at every policy anniversary at those corresponding policy anniversaries. a 60-day window opens up where you can execute on this return of premium rider and effectively take all your toys and leave the sandbox if you're looking at this from the client's perspective. Key point for that window, though, is that it's an all or nothing decision. You cannot partially execute on the return of premium and leave with half your toys. You have to pack up everything and cart it all with you. So you've got to walk away from, in this case, the entire $5 million insurance policy. And that's why we look at this policy split strategy, because we don't want to be forced into this all or nothing decision-making process. We're going to split this thing in two, and probably somewhere in the neighborhood of 50-50, 60-40 kind of split, because that's what's going to unlock the choices at retirement that the client's really looking for. And we're going to be able to do it with an identical outlay. So we're not going to ask the client to scratch a check for anything beyond what they would normally scratch a check for a single policy type of strategy. In fact, if you're a numbers guy, you can take a look at the screen here and you'll see a really pleasing set of numbers if that's how you take in data. Moral of the story here, on the left-hand side under the single policy heading, you have one policy, $5 million, annual premium just north of $36,000 bucks. And that middle column, the GROW rider, guaranteed return option rider, you'll see that window at year 15, $270,000 and change. And then you see the subsequent windows that kick in year 20 through 25, as I described a moment ago. In the middle, you have the split. We've got one policy at $3 million bucks, the corresponding premium and GROW rider values, and then a second policy at $2 million bucks, again with the corresponding premium and GROW rider values. And then on the right-hand side, we total that split policy strategy, and you can see that the numbers are in fact identical. So the client is doing the exact same thing in terms of their funding level and things like that. Their best practice is probably to scratch two checks. Home offices can sometimes misapply those premiums and things like that, so you're going to have two separate policy numbers. That's a bit out in the weeds. Again, pay attention to these GROW rider values. They are in fact identical in both scenarios, the single policy as well as the split. Great. So how would we actually execute on this? Well, we have to take this return of premium rider and remember that it's available at specific points in time, that it is an all or nothing strategy, and we want to look at these choices in retirement, the identical outlay. But here are the two choices that you have 20 years into the future. When you get to that magic age of 65 and you're thinking about retiring, you can surrender one of those policies, actually both of them if you want, and cash out completely. Or you can do what we call the surrender and pay up. And the decision-making process here is really focusing on integrating with the other planning that the client's got going on, and that'll make sense here in a minute when we look at another set of numbers. Specifically, this set of numbers. So the left-hand column is unchanged. That is the single policy solution that we were talking about. Now, in the middle, we've got a couple of things going on. You'll notice that there are some zeros that weren't there before. Well, there are two things going on here. Right here, in policy year 20, we're going to surrender this $2 million contract. I'm retiring if I'm this 45-year-old. It's now 20 years in the future. I'm age 65. I'm ready to hang it up. I don't need all $5 million of insurance any longer because I don't have that income replacement need. So I'm going to surrender the $2 million bucks, and I'm going to take this $289,000 and do something with it. And the question is, well, what am I going to do? Option number one is go ahead and put it in your pocket. Put it in your with the rest of the money you've got in your retirement war chest and use it to create the income that you're going to need during your retirement years. At the same time, you've also shed $14,000 in change of premium outlay. So there are two parts to that retirement income equation. One is what can I generate from my assets? The other is how can I control my expenses? So we've actually addressed both sides of that equation here. Expenses have dropped, and we've got more assets that we can use to generate income. However, there's a second choice that we could make, and that is to go ahead and drop that $289,000 into the remaining $3 million contract in the 21st policy year. That's going to effectively pay up that contract. So now I have a $3 million policy on the books, It is guaranteed for the rest of my life, and I don't have to pay another penny on that contract. So rather than drop that $289,000 into my retirement portfolio, I'm going to use it to pay up this other contract. I've wiped a $36,000 premium commitment off the board completely at that point from a cash flow perspective, and I have the $3 million available to me for that legacy planning or any other risk management needs that I have in terms of what happens when I ultimately pass away. You'll note that the grow rider value continues to be right there at $723,000. If we decide that this $3 million policy is really no longer needed, say in policy year 24, we can execute on that return of premium and go ahead and pull out that $723,000, almost $750,000, and drop that into our retirement plan from an income generation perspective. So all sorts of things we can do here. This is the policy split strategy, and there are really two flavors of it for you to remember. One is the surrender and cash out. The other is the surrender and pay up. I'll let you know which carrier we're using here when we get to the end of the conversation here today, because there is one contract that stands above the rest in terms of being able to utilize it for this specific strategy. The split the surrender strategy works both ways. I could absolutely surrender the $3 million and use it to pay up the $2 million. If I did that, I'd still end up with some dollars in my pocket at the end of the day in terms of additional retirement assets. So that this strategy works in both directions if you follow that logic. Now, I will remind you to go ahead and punch in any questions via that chat function or the questions dashboard if you are not tracking with me here, because we're going to move on to the second piece of this flexibility strategy. And to do that, we need to leave our 45-year-old for just a second and talk about another strategy and another case, and then we'll kind of connect the dots here in a minute. So this is another strategy called the reduced paid up 1035 exchange, 1035 in quotes, because we're not actually going to exchange anything. It is an alternative to a traditional 1035 exchange. It improves client cash flow, which is usually in the death benefit market why you're going to go ahead and execute on that kind of exchange transaction. And it helps us keep future sales open as well in case this client needs some additional insurance or there's a more efficient policy form available down the line that would be more appropriate for this client's needs. So the question, of course, then is, well, how does it work? Step one, we've got an existing contract, and the client's paying X dollars in premium. We'll look at a case study in a minute. We're going to stop paying premiums. We're going to reduce the face amount on that contract so that it's paid, guaranteed for the rest of that client's life. So if we've got $1 million, we may have to drop it to $500,000 in order to do that. Every policy is going to behave a little bit differently there. But the moral of the story is we want to essentially lock down that contract, drop the face, and eliminate any ongoing premium commitments to that existing policy. Now, that's going to leave a tranche of insurance that needs to be replaced with a new policy. So we're going to go ahead and do that with something that's available today. We're just going to reallocate the premium that's been being paid to the existing contract over onto this new contract. And in some cases, we'll be able to do that at a significant discount for the client. That the linchpin on this is the existing contract. As I mentioned, everyone behaves a little bit differently in terms of how much you're going to have to reduce the face in order to eliminate that premium outlay. In some instances, it's dramatic. You're going to have to walk away from 3/4 of the death benefit in order to do that. In others, it's only going to be a quarter of the death benefit. It's those policies where you don't have to give up too much of the death benefit that are really going to work the best in this strategy. Ultimately, what we're solving for is the client being able to pocket this savings on an annual basis. And when you look at a quick case study, which is on your screen right now, there's a real case. Male age 60 owns a guaranteed UL contract, guaranteed to age 100, $5 million. The annual premium commitment is $47,000. There is $175,000 of cash value, and the reduced paid up amount, that second set of numbers there, if we drop the premium to zero, the cash value remains at $175. The coverage drops all the way to $1.5 million. So there's a pretty dramatic decrease here. Only reason this case worked is we were able to go out and find new coverage totaling $3.5 million that only cost $41,000 a year. And if you look at that right-hand set of numbers, that brings us to a total line of $5 million, an annual premium outlay of $41,000 versus the initial premium outlay of $47,000, so pretty significant savings for the client. And that cash value is also preserved at $1.75 there. So in this instance, a traditional 1035 exchange would have required an ongoing premium of over $50,000. That's more than the client was already spending. Clearly not a strategy they were going to pursue. If we tried to do a traditional 1035 exchange of that $175,000 on a single pay basis, it would only purchase $627,000 of death benefit versus the $1.5 we keep by leaving it in the contract. So in this instance, this reduced paid up strategy saves the client 13% on an ongoing basis on a case that did not work when we looked at it from a traditional 1035 exchange standpoint. So moral of the story here, before we go back to our original sales idea of utilizing the policy split, is if you've worked on a case that involved a 1035 exchange and it did not work, quote unquote, because you couldn't save the client any money, get Amy on the phone. She'll work with Adam or myself or whatever we need to do in order to get an enforced ledger showing that reduced paid up strategy and run the numbers to see if we can resurrect this case that you may have sitting there in your desk drawer that you just couldn't get done the old-fashioned way, so to speak. However, for today's discussion, we want to continue to talk about this split strategy and how we would integrate this reduced paid up type of approach into that story as well. And we call this the combo strategy. We can still use the policy split. We still have that option to surrender one of the contracts and cash out, as we've already discussed. We also have the option to surrender and pay up. But what this client could do at age 65 is put one of those contracts to sleep via this reduced paid up strategy and eliminate their policy, their premium outlay. And we'll look at those numbers here in just a second. The moral of the story is this. Think about it like you're managing an insurance portfolio rather than just a policy. That's the thing that we've unlocked here, the strategy we've unlocked here by splitting it in two rather than going with a single policy strategy. And we need to consider what the client's needs are from a cash flow perspective in retirement, because we can toggle these things on and off in a whole bunch of different ways in order to match the risk management needs, their desire to leave a legacy, and their need for greater cash flow for living expenses and things like that in retirement rather than allocating it all to their insurance portfolio. So here's how that might look. Single policy hasn't changed. The policy split strategy, the three columns on the three sets of numbers on the right, that's changed a little bit. Instead of surrendering that $2 million policy, we're just going to put it to sleep. We're going to stop paying premiums, and we're going to reduce the face amount by $1 million. Now this client has $4 million of insurance in force, an annual premium outlay in retirement of almost $22,000, so that they can maximize what they leave from a legacy perspective. And again, this is just one example of what they can do. You could absolutely flip this where you're going to put the $3 million policy to sleep and maintain the two. It's completely up to the advisor, you all listening in, and of course the client to determine which of these strategies, which of the options is going to be right. And I'll lay out all the potential outcomes that we can generate via this simple $3 million, $2 million split here in just a couple of minutes. Before we get there, though, there's one other element of this contract that has really become more and more important as we've started to become more and more aware of exactly how many of us are ultimately going to need care for a chronic or long-term care event in our future. We probably all know that stat. 70% of us, 7 out of 10, are going to need some sort of care during our lifetime. The contract we're talking about today, the policy we're talking about today, comes with an embedded critical illness rider. It's included in the base contract, and therefore there is no premium charge for it. You pay for it on the back end, so to speak, when you actually need the benefits. And there are some absolutely wonderful strategies for managing that claim and managing your premiums during that claim that will make this a much more effective contract and approach for your clients than just continuing the old vanilla route, so to speak. So pertinent details of this rider on this contract. Up to 80% of the face amount is available for chronic illness. It's capped at $1 million per policy. Note that because we've split the policy here, we actually have a total pool of $2 million, another benefit for this client. Premiums continue when the insured is on claim. The issue, as I see it, is the net benefit, right? Any benefits that I'm taking out of this contract specifically for chronic illness are going to be offset, quote unquote, by any premiums that I have to continue to pay. So the question becomes if there's a better way to manage this claim than continuing to scratch out that premium check when I'm receiving benefits under this chronic illness rider. It doesn't take a rocket scientist to figure out that, yeah, there is a better way here. So let's look at the old-fashioned way, right? I'm a numbers guy. This client, the same 45-year-old that we started with, has reached age 75. The wheels are starting to fall off from a health standpoint, and he is going to need chronic illness benefits, and he's going to go ahead and trigger that rider. Now, there's a discount that is applied. It's not a dollar-for-dollar type of benefit here. That's how you pay for the benefits. In this case, you can see that even though we're eligible for the full IRS per diem maximum for this particular client, because of the discounting, it's only going to generate $48,000 of benefits in this first year. That's assuming a 10-year life expectancy. We'll get to that more here in just a minute. Premium outlay is $36,000. That means the net cash flow for this client is a mere $12,800. That does not pay for much in the way of benefits from my perspective, probably not from yours either. If this magical, mythical client here manages to live all the way out to age 85, they will have generated $304,000 in net cash flow, but it will have cost them almost $1 million in death benefit to get there. If they pass away at age 85, the total benefits they'll get out of this contract are summarized down here at the bottom. $4.3 million, meaning their net cost was right around $675,000. That's inclusive of benefits they actually received and benefits that were used to quote-unquote pay for this coverage. Now, one of the things I know about clients when they need chronic illness benefits is that they have a shortened life expectancy. So there's really no reason to fund the contract to be guaranteed out to age 105, 110, 120, whatever the strategy was, when I'm age 75 and I'm already sick enough to need benefits. I am not going to make it to age 105. I can just about guarantee it. So I'm going to change the way I fund this contract, because what I really need is the cash flow, inclusive of both premium outlay as well as the benefits that I receive to fund this care that I now require. So the question is, does that change how we fund the policy? The answer is yes, and here's why. If I'm age 75 and I've funded this thing at $36,000 a year for the two policies for that 30-year period from age 45 to 75, I can turn off the premiums starting at age 76, and that policy is guaranteed to last another 15 years. And if I'm already that sick, I am guaranteed to not last another 15 years. So the client will expire before the policy does, which is what you want when you're buying life insurance. You can see a couple other scenarios. If we get out to age 80, the policy will last 12 years. 85, it'll last 10 years. You see how this plays out. Moral of the story, we can turn off the premiums, eliminate some of that cash outlay for the client, freeing up that cash flow for them to spend on their benefits or for their care. And then you're going to stack whatever they get out of the contract in terms of acceleration of death benefit on top of that premium savings. And those numbers look like this. Same time period. Client gets sick at age 75, starts taking benefits at age 76, immediately turns off the premiums. The net cash flow there looks significantly better. And again, this client lasts 10 years, dies at age 85. The net cost is significantly less, $380,000 and change, for that same, actually increased net benefits in this instance. So scenario one, where we continue to pay premiums, the net cost is $675,000. Scenario two, where all we do is turn off the premiums, net cost for that client of those benefits is $382,000. It's a very significant savings of almost $300,000 for that client. Actually, for the client's beneficiaries, if we're being honest about it, they've passed away, they're not using those dollars. It's the legacy that they've left behind. Now, there's another way that we can even think about this. I mentioned, a few moments ago that there's a discount rate that is applied when you accelerate benefits on these back-end type of riders that don't have a premium charge associated with them. Takes the discount rate and multiplies it by the life expectancy in years, and that's how much you're going to essentially pay on an annual basis for that acceleration, and the client will receive the net of the IRS per diem max less this discount factor that equals the net benefit to the client, which means that the longer we can delay the claim, the better. And we want to spend, quote unquote, the premium savings first. Now, this example is a little exaggerated to make a point, but follow me through the numbers here. Same client gets sick at the exact same point in time and is going to spend their premium savings, their $36,000 a year. They don't need full-time care or anything like that. They've got some issues, but this $36,000 is going to be able to fund what they need in terms of care. Again, oversimplified strategy. Just follow me through it here. Until they get to age 80. At age 80, they need a greater level of care. Maybe they're into that skilled nursing facility, whatever the story may be. They're going to turn on the benefits from their chronic illness rider at that point. So step one at age 76 was just to stop paying premiums and use that premium savings to pay for the care. Step two, at age 80, go ahead and trigger the accelerated benefits. Because their life expectancy is significantly shorter at that point, the benefits are greater. And you can see, again, we've generated some pretty significant savings for the client. They're going to pull $500,000 in benefits net out of this, and it's only going to cost them $110,000 to do so because they've delayed triggering that claim, and that's $565,000 of savings for the client's beneficiaries. $565,000 more are going to pass to their beneficiaries as a result of this strategy. So, all good things. Do I think you can ultimately push a claim out 5 years if you can trigger benefits at age 75 and make it out to age 80? Probably not. Let's just be honest. But the moral of the story is think about how you want to manage premiums as well as manage that claim. Spend the premium dollars first. Delay executing that rider as long as possible. It's going to make it that much more efficient for the client. It's all about maximizing what they actually use during their lifetime for benefits and ultimately pass on to their beneficiaries, which is why they bought this coverage in the first place and ultimately elected to maintain it into their retirement years. So, in summary, we've got 4 reasons to sell what is Mutual of Omaha's no lapse guarantee or guaranteed universal life contract. That's the carrier we've been talking about today, guys. Policy split / surrender strategy that we talked about at the onset of the call here. The policy split reduced paid up strategy we talked about next. The chronic illness claim management strategy that we just went over. And of course, if you have one of those cases that we talked about that did not work via traditional 1035 exchange, you can sell this Mutual of Omaha product as the new coverage, utilizing that 1035 alternative approach that we talked about. So 4 approaches or sales ideas or strategies to talk about, and all embedded in one contract here today, which is why this policy for Mutual of Omaha is the most flexible GUL contract on the market, giving your client and you as their advisor ultimate GUL flexibility without having to get up the guarantees. Let's be clear. Clients like those, and we like having them too, particularly when we don't have to put on a pair of handcuffs in order to get them. That's certainly the case here. I mentioned in closing that I was going to give you the spectrum of possible outcomes here. Last call for questions. I have not seen any come in yet. Amy, if I'm missing something, go ahead and give me a note on that. Here is the spectrum of possible outcomes. Just by splitting this policy between a $3 million and a $2 million, at age 65, that client could do any of these 8 things. One is obviously maintain the full $5 million. They could also maintain $4 million, $3.5 million, probably even $4.5 million if I wanted to really get down to the gnat's eyelash on this. But then these smaller face amounts at $3 million and below, there's no premium outlay. That's what that PU stands for. It's paid up. Client's done paying premiums. They can allocate all that cash flow to their other needs in retirement. And in some instances, in fact, these 4 instances, the $1 million through $2.5 million possible outcomes here, the client would actually walk away with cash in their pocket on top of eliminating their cash outlay. And honestly, at age 65, when we've focused our attention here, they could walk away if they surrendered the whole contract with $723,000 in cash, and put that into their retirement plan and move on. If all their beneficiaries predecease, or their retirement plans don't pan out the way that they thought they would, business losses, market losses, whatever the case may be, they've got this as a backstop, which is powerful, very, very powerful. And that, Amy, brings me to the end of my my monologue for this morning, and we're at 9:03, so
yeah.
I've gone 3 minutes over. I apologize.
That's all right. We do actually have a question coming in, and I'm going to, here it is, I think it's by Ralph. Let's see. So Jeff, does the RPU 1035 work with existing policies other than GUL?
Yes. In fact, the genesis of that sales idea was old whole life contracts, to be honest. I probably wouldn't pursue it with something with a policy that wouldn't allow us to lock in that guarantee. So if it's a variable contract, probably not going to work. Indexed might, if you can run it at a conservative enough rate of return assumption to allow everybody to sleep at night. But again, that's going to be a little more aggressive. But
exactly.
Whole life contracts.
Yeah, and this was really focused on kind of the GUL chassis. So.
Yep.
That's awesome. Jeff, thank you so much. Your information is always fantastic. And, I had some things to say, but you do such a great job. So I appreciate it so much. And I'm sure everybody on this call got, a ton out of this. Really the ask, guys, is really pretty simple. Give us a shot to earn your business. My information is at the bottom there. I hope you guys can see it. But my number is 703-554-1175. Call me. If you have any opportunity sitting in front of you, I will work to earn your business. Jeff's an amazing resource. We work with Adam, and he's an amazing resource. So if you have old 1035s or, anything, you wanted me to do a comparison, absolutely. I think with that being said, Jeff, do you have any closing comments?
Other than to reiterate that we've got a small army of people to work on your cases. I think that's it. The real one is that case that is sitting there that you couldn't get done. And there are 2 elements. One is obviously the strategy on this 1035 alternative today. But one of the best kept secrets about the Kessler Life Group is we have underwriters, 3 of them in fact, that we work with that are home office experienced, but have moved away from the quote-unquote dark side over to the sales side, and they are the salesperson's underwriters, meaning that they don't get paid until you do in some instances, and they have worked, I'm not going to say miracles, but pretty damn close to miracles, getting cases upgraded, getting them just to that underwriting classification that unlocks the deal and makes it the right move for the client to move forward on. So not only can we employ a superior strategy or design like we talked about here today, we've got some talent on the bench that can help us maximize that underwriting offer as well.
Absolutely. And I was just looking at my calendar, just so everyone on the call, please be expecting an email from me. And then, you can shoot me an email or call me. I am really open tomorrow and Friday, actually. So we could set up, 15, 30 minutes, whatever you guys need. And we can kind of take it from there and explore any more questions you have. I don't see any more questions, Jeff. So with that being said, again, thank you. And everybody on this call, have a great day.
Thanks, you guys. Appreciate you being here.